All right, let's dive in today. We're going to be cracking open Warren Buffett's 2010 letter to Berkshire Hathaway shareholders.
Okay.
Now I know what you're thinking.
Sounds right.
Shareholder letter sounds dry.
Right.
But trust me, this is Buffett we're talking about.
Right.
This letter is packed with so much more than just numbers.
Way more.
This is like a glimpse. It's like a glimpse into the mind of one of the greatest investors of all time.
Yeah.
I mean, this is as close as you're going to get to sitting down with the guy and picking his brain.
Pick his brain.
About, investing business and, even life itself.
Exactly. And what I think is fascinating about this letter is how it reveals Buffett's thinking about everything.
Yeah.
From investing to business management to, like you said, his outlook on the world.
Right.
It's like a masterclass in long-term thinking and value creation.
Absolutely. Absolutely.
So buckle up.
Let's jump right in.
Yeah.
Berkshire's per share book value increased by 13% in 2010. Not too shabby, right? Especially when you consider the 46-year track record.
Mm-hmm.
That's a compounded annual growth rate of 20.2% in book value.
That's incredible.
I mean, that is unheard of.
Right.
And it just shows the power of long-term thinking and compound. We're going to talk a lot about compounding in this deep dive. But I think it's really important to understand book value.
Right.
Because it gives you a sense of the company's intrinsic worth.
Absolutely.
It's a more conservative measure than market value, which can fluctuate wildly based on, whatever the sentiment is at the moment. Right.
Exactly. And when it comes to Berkshire, book value is actually an understated proxy for intrinsic value.
Right.
They have so many wholly owned subsidiaries that are generating cash flow.
Yeah.
That aren't necessarily fully reflected on the balance sheet.
Right, right. It's like the tip of the iceberg, right?
Exactly.
All right, so let's talk about a big move that Berkshire made in 2010.
Okay.
The acquisition of Burlington Northern Santa Fe, the railroad giant.
The railroad giant.
Okay, now this wasn't just any acquisition.
No.
This was a strategic bet, a massive bet on the future of American infrastructure.
It was.
And railroads, they have some serious advantages over trucking.
Absolutely.
I mean, think about it. They're more cost-effective and way more environmentally friendly.
Right.
I mean, the sheer volume of goods that can be transported by rail compared to trucks and the fuel efficiency makes a huge difference.
And think about the congestion on the highways.
Oh, my God.
Right. Taking all those trucks off the road is not only good for the environment, but also for the flow of goods.
Yeah. Yeah, it just makes sense.
It just makes sense.
From so many different angles.
Absolutely.
And Buffett was clearly excited about BNSF's potential, right? He saw it as a critical piece of the American economy.
He did.
And he wasn't afraid to invest big in its growth.
Mm-hmm.
He says in the letter, our railroads business is booming.
Yeah.
We are in the midst of a surge in traffic that will require us to invest massive sums in new equipment, new track, and new people.
So they're going all in?
They're going all in, right? Which is really interesting because this letter was written during a time when there was a lot of pessimism about the U.S. economy.
A lot of pessimism.
This was right after the financial crisis. Things were still very uncertain.
Yeah.
But you'd never know it from reading Buffett's words.
You would never know it. He was incredibly optimistic about America's future.
Absolutely.
I mean, he really was a contrarian.
He was.
In that sense, and he believed that, human potential was far from exhausted and that the American system, while not perfect,
was still the best engine for unleashing that potential.
Absolutely.
So he really pushed back against the doom and gloom by reminding everyone that America has always faced challenges.
Right.
And it's always come out stronger on the other side.
Absolutely.
And I think that's a really important reminder for all of us, right?
Well, it is, yeah.
We tend to get caught up in the short-term noise and lose sight of the bigger picture.
Yeah.
And Buffett, with his long-term mindset, he always brings us back to that.
He does.
And that long-term thinking is also evident in how he talks about Berkshire's intrinsic value.
Right.
He breaks it down into 3 pillars.
Okay.
Investments, earnings from non-insurance businesses.
Okay.
And the most important one, in his view, how effectively they'll deploy capital
in the future.
in the future.
The what will they do with the money question.
Right. Exactly. Exactly.
Yeah, huge question.
So let's start with investments.
Okay.
One of Berkshire's biggest advantages is its access to insurance float.
Right.
That's essentially money they collect from premiums that they can invest while they wait to pay out claims.
While they wait. Right.
So it's like having
a
giant pool of free money that they can use to buy companies and stocks, which gives them a huge edge over other investors.
Absolutely. And that's what allows them to make those big bets.
Right.
Like the BNSF acquisition.
Right.
They've got that pool of capital that they can deploy when they see an opportunity.
Yeah. And as you look at the tables in the letter, you see how Berkshire has been shifting its focus. They're not just relying on investment returns. They're building up earnings from their non-insurance businesses as well.
Yeah. So they're becoming less reliant on the stock market.
Right.
And more focused on building these cash-generating businesses.
Yeah. Which brings us to that third pillar.
Okay.
What Buffett calls what will they do with the money factor?
That's the big one.
And isn't that something that, we all kind of wonder about when we invest in a company?
Absolutely.
Right. Like, what are they going to do with the money?
Right. Are they going to blow it?
Are they going to squander it?
Right.
Are they going to make smart decisions?
Or are they going to reinvest it wisely and compound it?
Right. Exactly.
So Buffett argues that just because a company has a lot of cash doesn't mean it's creating value.
Right.
It all comes down to
how they use it.
How effectively that cash is reinvested.
Right.
He points to examples like Sears Roebuck.
Oh, yeah.
And Montgomery Ward.
Once great companies that were
ultimately destroyed by poor capital allocation.
So it's not just about
the cash.
It's about the people making the decisions.
Right.
You need a management team that's skilled at deploying capital. Like Sam Walton.
Like a Sam Walton, right. Who turned Walmart into a retail giant by making smart investments in stores, in distribution centers, in technology, and all the things that help them grow.
Yeah, so it's about finding those managers who can take that capital and allocate it wisely and create value for shareholders.
Yeah, so we've talked about investments. We've talked about the earnings from non-insurance businesses.
Right.
Now let's talk about, what sets Berkshire apart from the competition.
Okay.
Right. Buffett points to three main advantages.
Right.
The quality of their managers.
Yeah.
The flexibility they have in allocating capital.
Okay.
And their unique company culture.
All right. So let's unpack those.
Yeah. And what struck me about the way Buffett described his managers is the level of trust that he has in them.
Yeah.
He talks about how many of them could easily retire.
Right. And live very comfortably. But they choose to stay because they're passionate about their businesses.
They love what they do.
Right. And that says a lot for the kind of culture that he's built.
Right. It's a culture of decentralization and autonomy.
Right.
Buffett gives his managers an incredible amount of freedom to run their businesses, and he trusts them to make the right decisions. He doesn't believe in micromanaging or second-guessing them.
It's almost like he's created this team of all-stars, and he's just letting them play their game.
Yeah.
Right? He's not trying to coach them.
He's not trying to meddle.
He's not trying to, He's just giving them the resources they need and letting them do their thing.
Cheering them on from the sidelines?
Exactly.
Yeah, and that ties into the flexibility advantage.
Right.
Berkshire isn't constrained by traditional corporate structures. They can move capital between different industries and investments without having to go through layers of bureaucracy.
Yeah, it's like they're nimble.
They're nimble, they're agile.
They can adapt quickly. For changing circumstances, which is essential in today's fast-paced business environment.
Right. And that agility allows them to capitalize on opportunities that other companies might miss.
Right.
They can move quickly and decisively, which is essential in today's fast-paced business environment.
Right. And then there's the ownership culture.
Right.
Buffett places a huge emphasis on aligning the interests of directors, managers, and shareholders.
Everybody's in the same boat.
Everybody's in the same boat, right. Everyone is encouraged to think like an owner.
Yeah.
Which creates a sense of shared purpose and accountability.
And that's what drives long-term value creation.
Absolutely.
It's a powerful formula.
It is.
It's a powerful formula for long-term value creation.
It is.
Now, I think it'd be interesting to dive into a specific example
Okay.
that illustrates Buffett's investment philosophy.
Okay.
And I think the story of Geico is a great one.
Oh, yeah.
It's a fascinating story.
It is.
So Buffett first encountered Geico
Okay.
in 1951
Okay.
when he was just a 20-year-old student.
Wow.
He was researching his investing hero, Ben Graham,
Yeah.
who happened to be the chairman of Geico at the time.
So this is like fate, right?
Right.
Talk about being in the right place at the right time.
It's amazing how these things happen.
Yeah.
Right.
And this story highlights something important.
What's that?
Always be curious. Always be learning.
Mm-hmm.
Because you never know where it might lead you.
You never know.
You never know what doors it might open.
Exactly.
So fast forward to 1996.
Okay.
Berkshire finally acquired the remaining 50% of Geico.
They went all in it.
But here's the interesting part.
Okay.
The price they paid implied a value far greater
Mm-hmm.
than the company's tangible net worth.
Now, tangible net worth is basically what a company's assets would be worth
Nope.
if they were sold off.
Okay.
So you take all their buildings, their equipment, everything they own.
Right.
You add it all up, that's their tangible net worth.
Okay.
The difference between that and what Berkshire paid
Yeah.
is what we call goodwill.
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 So are we talking about like warm, fuzzy feelings here?
Not exactly.
Okay.
In accounting terms, goodwill represents the value of things that are hard to quantify,
Okay.
like a company's brand reputation, customer loyalty,
Okay.
and talented workforce.
Right.
And in Geico's case, their loyal customer base and low-cost operations were incredibly valuable.
Okay.
Buffett was willing to pay a premium for that.
So he understood that Geico had built a durable competitive advantage,
Absolutely.
something that couldn't easily be replicated.
Right, that moat you're talking about.
That moat, exactly.
Yeah,
And of course, we can't talk about Geico without mentioning Tony Nicely,
the legend.
the company's longtime CEO.
Yeah.
Buffett credits Tony's leadership for Geico's phenomenal growth and profitability.
He was a rock star.
Absolutely. And under his watch, Geico became one of America's leading auto insurers, and its market share just kept climbing.
Good climbing.
So we've got a sense of Buffett's investment philosophy and how he thinks about building value.
Right.
Now let's zoom out a bit and look at the four major sectors that make up Berkshire Hathaway's business empire.
The four pillars.
The four pillars, exactly.
All right.
This will help us understand the diversity of their operations and how each piece contributes to their success.
So first up, and by far the biggest, is the insurance sector.
Okay.
This is the engine that's driven Berkshire's growth for decades.
Right.
And it all comes down to one word: float.
Float. I'm sensing a theme here. Remind me again how that works.
So think of it this way. Insurance companies collect premiums up front,
Okay.
but they don't pay out claims until later.
Right.
That means they have this pool of money, the float,
Okay.
that they can invest for their own benefit.
So it's basically
Free money.
free money, right?
Free money.
They're holding on to this money that they don't have to pay out
Right.
until some future date.
Exactly.
And as long as they're underwriting profitably, meaning they're collecting more in premiums than they're paying out in claims and expenses, that float becomes a valuable source of free capital.
That's the key.
Right.
The key is underwriting profitably.
Right. So the problem is most insurers aren't that great
No, they're not.
at underwriting.
They're not.
Right.
They often operate at a loss.
Right.
Meaning they're effectively paying to hold on to that float.
Yeah. Yeah.
But Berkshire is different.
Berkshire's is different.
They've got this incredible track record of underwriting profitability,
Right.
which is why they've been able to compound that float over so many years.
And it all comes down to having exceptional insurance managers, right?
Yeah, people like Ajit Jain and Tad Montross, who we talked about earlier.
Yeah, yeah.
Ajit Jain runs Berkshire Hathaway Reinsurance Group.
Yeah.
And he's considered one of the best reinsurance underwriters in the world.
Wow.
His ability to assess risk and price policies is legendary.
So it's not just about, saying yes to every deal that comes their way.
No, it's not about writing every risk.
It's
about having the discipline to walk away.
Having the discipline to walk away from
bad risks.
Bad risks.
That's right.
Right. And that's something that Buffett really emphasizes in the letter. It's not just about maximizing the float.
Right.
It's about managing it intelligently.
You got to manage it wisely.
Yeah.
You got to have that discipline.
Right.
And that brings us to the 4 disciplines of a sound insurance operation, as Buffett outlines in the letter.
Okay, what are those?
Understanding risk.
Number 1.
Pricing accurately.
Okay.
Having the discipline to say no. And, of course, managing expenses effectively.
So it's a combination of skill, discipline, and a deep understanding of the insurance business.
You got to know what you're doing.
Right.
And that's what's allowed Berkshire to outperform the vast majority of insurers who consistently struggle to generate underwriting profits.
Yeah, it's really remarkable.
It's a tough business.
It is a tough business.
Yeah.
But they've really figured it out.
They've cracked the code.
Yeah, absolutely.
Absolutely.
So we've explored this fascinating world of insurance float.
Yeah.
Which is a huge part of Berkshire's success. And we're gonna dive into the other sectors of Berkshire's business in the next part of our deep dive.
Right. Sounds good.
So stay tuned for that.
Looking forward to it.
All right. Thanks for joining us.
Thank you.
For part 1.
All right.
We'll be back soon.
Okay. With part 2.
Sounds good. Okay, so we've explored the fascinating world of insurance float.
Yeah.
Which is a huge part of Berkshire's success.
It is, yeah.
Now let's shift gears a bit and talk about the other major sectors of Berkshire. We've got manufacturing, service, and retailing operations.
Right.
I mean, that's everything from candy to private jets.
What a mix.
What a mix, right?
Yeah.
I mean, talk about diversity. It's a testament to Buffett's philosophy of not putting all your eggs in one basket.
It is. And this sector is particularly interesting because it demonstrates his willingness to learn from mistakes.
Yeah.
He's not afraid to admit when he's made a miscalculation.
Right. And he does that in this letter.
He does.
He admits that he's made some miscalculations in this area. He's misjudged the competitive landscape in certain industries.
Right.
Or the long-term economics just didn't pan out the way he expected.
Yeah, things change.
Things change.
And sometimes you just don't see it coming.
And sometimes you just don't see it coming, and that's okay.
It is.
What's refreshing is that he's open about these missteps. He doesn't shy away from acknowledging where he's gone wrong.
Right.
And that's an important lesson for any investor.
It is, yeah.
We all make mistakes.
Absolutely.
It's what we learn from them that matters.
Right. It's about having that humility to recognize when you're wrong.
Right.
And to adjust course.
Absolutely. Absolutely. And he's quick to highlight the successes, too.
Yeah, he does.
He mentions 4 companies.
Okay.
TTI, Forest River, CTB, and even a shoe company, H.H. Brown.
A shoe company.
All achieving record earnings in 2010.
Wow, that's impressive.
Right.
Yeah.
And what's interesting about these companies is that they're not, flashy, high-tech businesses.
Right.
They're solid, well-managed companies that make essential products.
Right.
It goes back to Buffett's focus on intrinsic value.
Yeah.
He's not looking for the next hot stock.
Right.
He's looking for businesses that generate consistent cash flow and can compound value over time.
Right. It reminds me of that famous quote.
What's that?
Boring is beautiful.
Boring is beautiful. I love it.
Yeah.
And sometimes the best investments are the ones that fly under the radar.
Absolutely. The ones that nobody's paying attention to.
Right. Exactly. Now there's a story here that I found particularly fascinating.
Okay.
NetJets.
NetJets.
It had been a financial drain on Berkshire for years.
Wow.
Even though it was wildly popular with customers.
How does that happen?
Right. So NetJets, for those who aren't familiar, is a fractional ownership program for private jets.
Okay.
So basically, you buy a share of a jet.
Okay.
And you get a certain number of flight hours per year.
Okay.
It's a brilliant concept, but the execution was flawed.
So they had some operational issues.
They had some operational issues, right?
Okay.
So Buffett brought in David Sokol to turn things around.
Yeah.
And the turnaround was dramatic.
Wow.
NetJets went from a significant loss to a healthy profit in just a year.
That's incredible.
I know.
That's a quick turnaround.
It is, and it's a great example of Buffett's trust in his managers.
Right.
He gave Sokol the authority to make the necessary changes and didn't interfere.
He let him do his thing.
Yeah, he believed in hiring talented people and letting them do what they do best.
Absolutely.
It's interesting, too, that Buffett's own family uses NetJets.
Oh, really?
Yeah.
Wow.
They've flown thousands of hours on the company's planes.
So he's putting his money where his mouth is.
Exactly. Exactly. And that says a lot about his confidence in the service and safety.
It does, and it speaks to his alignment with his shareholders.
Right.
He's not just talking the talk.
He's walking the walk.
He's walking the walk.
Exactly. Exactly. Okay, so we've got NetJets back on track.
Okay.
What are some of the other stars in this sector?
Well, the letter also highlights the performance of Marmon, Iscar, and McLean.
Okay.
All significant contributors to Berkshire's earnings.
Right.
These are all companies that operate in different industries, but they share some common characteristics.
Okay.
Strong management, efficient operations,
Okay.
and a focus on profitability.
It's a reminder that diversification isn't just about investing in different industries. It's also about investing in different types of businesses.
Different business models.
Right.
Different management teams.
Yeah, exactly. Exactly.
And it's about finding businesses that are resilient, that can withstand economic downturns.
Right. And of course, not all of Berkshire's businesses were immune to the challenges of the 2008-2009 recession.
Yeah, the Great Recession.
Yeah.
Hit a lot of businesses hard.
Yeah, their home construction-related businesses, for example, were hit hard by the housing slump.
Makes sense.
Right. But even in those challenging times, Buffett remained optimistic.
Yeah.
He emphasized that Berkshire has a forever time horizon, meaning they're not phased by short-term fluctuations.
Right.
They're in it for the long haul.
They're playing the long game.
They're playing the long game, and that long-term perspective is one of the keys to their success.
Absolutely.
They're not pressured to chase quarterly earnings or react to every market blip.
They can just focus on building value over decades, not months or years.
Right, exactly. Exactly. All right, let's move on to the third sector.
Okay.
Regulated capital-intensive businesses. Okay.
This includes BNSF, which we've already discussed, and Mid-American Energy.
Okay.
Now, these businesses are unique because they require massive investments in long-lived regulated assets.
We're talking about railroads, pipelines, power plants,
Exactly.
things that cost billions of dollars to build and maintain.
Right, and to finance those investments, they often take on a lot of debt.
Yeah, that's the nature of the beast when
Right.
you're talking about these kinds of infrastructure projects.
Right, and that might make some investors nervous.
Yeah, I can see that.
But Buffett doesn't seem too worried about it.
No, he's not.
Why is that?
Well, he explains that BNSF and Mid-American have strong earning power,
Okay.
even during economic downturns.
Okay.
And because they're regulated, they have a certain degree of predictability in their revenue streams.
Okay.
They're not as vulnerable to competition
Right.
as companies in other industries.
So it's a trade-off. They
Yeah.
take on more debt.
But they have more stable earnings.
Right, and Buffett believes that wise regulation and wise investment go hand in hand.
Okay.
He sees these businesses as essential to the American economy, and he's willing to invest heavily in their future.
He calls railroads the circulatory system of the American economy.
Yeah, I like that analogy.
And BNSF is the largest player in the game.
The 800-pound gorilla.
Exactly. They transport a huge chunk of the country's freight.
Yeah.
And that share is only likely to increase in the coming years.
Right, as the economy grows.
Right, as the economy grows, as more goods are shipped across the country.
More stuff.
More stuff, exactly. And then we have Mid-American Energy.
Okay.
Berkshire's utility and energy company.
Right.
This is another business. It's all about infrastructure, electricity generation, natural gas transmission, and increasingly renewable energy.
Yeah, they're really leaning into renewables.
They are. And Buffett is particularly proud.
Yeah. Of Mid-American's investments in wind generation. He points out that they'll have more wind generation capacity than any other regulated utility in the country.
Wow.
By the end of 2011.
That's amazing.
It's pretty amazing. And it's interesting to see how Buffett's views on renewable energy have evolved over time.
Right. He wasn't always a believer.
He wasn't always a believer. He was initially skeptical of wind and solar. But he's become a believer in their potential.
Yeah, the economics have changed.
The economics have changed, and he sees it as both a good investment and a good thing for the planet.
Right, so it's a win-win.
It's a win-win, exactly. And it shows his willingness to adapt and change his mind as the facts on the ground change.
Yeah, which is an important quality for any investor.
Absolutely.
I got to be able to adjust your thinking as the world changes.
Right, because the world is constantly changing.
It is.
And we need to be able to adjust our thinking accordingly.
Mid-American is also a great example of operational excellence.
Oh, how so?
They've taken their pipelines, which were once ranked last
Oh, wow.
in terms of efficiency,
Yeah.
and turned them into some of the best in the industry.
That's impressive.
I know. It shows that even in a regulated industry, there's room for improvement
Right.
and innovation.
Yeah, you can always get better.
You can always get better, and it speaks to the quality of management
Right.
at Mid-American. They're not content to rest on their laurels.
They're always looking for ways to improve.
Exactly. They're constantly striving to improve.
That's the Berkshire way.
Exactly. Okay, and finally, we have the smallest sector,
Okay.
finance and financial products.
Okay.
This is a bit of a mixed bag, but it includes Clayton Homes,
Hey.
the country's leading producer of manufactured homes.
All right.
Now, Clayton Homes was facing some challenges during the housing downturn,
Right.
particularly in the area of financing.
Yeah, that was a tough time for anybody in the housing business.
It was, and Buffett criticizes government policies that favor site-built homes over manufactured homes, arguing that they distort the market and make it harder for lower-income families to achieve homeownership.
Yeah, because manufactured homes tend to be more affordable.
More affordable.
Right.
Right. And he believes that manufactured homes are a more affordable and efficient way to provide housing.
Right.
And he's frustrated that government regulations are making it more difficult for Clayton Homes to serve this market.
So he sees it as a kind of a social issue as well.
He does. And it's interesting to see how Buffett applies his value investing principles to social issues. He's not just looking at the bottom line.
Right.
He's thinking about the broader impact of his investment.
He's thinking about the stakeholders.
He is. And he's not afraid to speak out when he sees policies that he believes are unfair or counterproductive.
Yeah, he's not afraid to use his platform.
He's not. He also highlights Clayton Homes' impressive loss experience during the housing crisis, attributing it to their conservative lending practices. They focused on getting meaningful down payments from borrowers and making sure that monthly payments were a reasonable percentage of their income.
Common sense lending.
Right. It's a stark contrast to the reckless lending practices that fueled the housing bubble and led to the financial crisis.
A lot of people got burned.
A lot of people got burned. And Buffett believes that Clayton Homes' approach is a model for responsible lending and that it could have prevented much of the pain experienced by homeowners during the downturn.
Right. So he's not just criticizing.
Right.
He's also offering solutions.
He's offering solutions, right. And it's a reminder that ethical lending practices are not just good for borrowers.
Right.
They're good for lenders as well.
Absolutely. Everybody wins.
Everybody wins. Exactly. And on a personal note, Buffett also shares in the letter that he considers his own home purchase to be one of his best investments. Even though he acknowledges he would have made more money had he rented and invested the money in stocks.
Interesting.
But he says, for the $31,500 I paid for our house, my family and I gained 52 years of terrific memories. Right. And counting.
So it's not always about the money.
It's not always about the money.
Sometimes it's about the memories.
It's about the quality of life. It's about the memories.
Absolutely.
Right. And that's a really important reminder, I think, for all of us.
It is, yeah.
Now let's move on to one of the most critical aspects of Berkshire Hathaway. It's corporate culture. Buffett believes that culture is more important than rule books.
Interesting.
When it comes to shaping an organization's behavior. It's not about having a thick manual outlining every do's and don'ts.
Right.
It's about creating an environment where people feel empowered to do the right thing, even when no one's looking.
Right. It's about having that intrinsic motivation.
Exactly. And at Berkshire, that culture is built on a foundation of trust, autonomy, and a shared sense of ownership.
Powerful combination.
It is. And it's fascinating to think about how that translates into the day-to-day operations of such a vast and diverse organization.
Right. I mean, we're talking about hundreds of different businesses operating in all sorts of industries.
Right. How do you create a consistent culture across all of those different businesses?
It's a challenge.
It is a challenge.
But one of the key elements is decentralization.
Okay.
So think about it. Berkshire's headquarters is incredibly lean.
Right.
they have a small team handling corporate functions for a massive conglomerate with hundreds of thousands of employees.
Yeah, that's pretty amazing.
It is, and it's a testament to Buffett's belief in empowering his managers.
Right.
And giving them the freedom to run their businesses without interference.
Yeah, he hires good people and gets out of their way.
He gets out of their way.
Right. It's also a reflection of his own management style.
Yeah, how so?
He's famous for working from the same office he's occupied for decades.
Right, no corner office, no fancy suite.
No fancy corner office or executive suite.
Yeah.
It's a reminder that he's not about appearances or status symbols.
He's focused on substance.
He's focused on substance over style.
Right.
Exactly. Exactly. And that frugality extends to his management of Berkshire as well. He dislikes unnecessary spending and believes that a penny saved is a penny earned.
It's an old-fashioned value.
It is, but it's a good one.
It is.
Right.
Yeah.
And that philosophy is deeply ingrained in Berkshire's culture.
So it's not about being cheap.
It's not about being cheap.
It's about being responsible.
Yeah. It's about being responsible with shareholder money.
Right.
And that's another key aspect of Berkshire's culture, the focus on long-term value creation.
Right. And that permeates everything they do.
It does. It does. And Buffett is not interested in short-term profits.
No.
Or Wall Street's obsession with quarterly earnings.
He doesn't care about that.
He doesn't care about that.
He's looking at the long game.
He's playing the long game, building businesses that can compound value for decades to come.
Right. And that long-term mindset is reflected in their acquisition strategy as well.
Yeah.
They're not looking for companies they can flip for a quick profit.
Right.
They're looking for businesses they can own forever.
They are. They are. Businesses with durable competitive advantages.
Right.
Strong management teams. And the potential to generate consistent earnings over time.
Exactly. And once they acquire a business, they tend to leave it alone.
Right.
Allowing the existing management team to continue running things.
Yeah. And that's a pretty unusual approach.
It is.
In the world of corporate acquisitions.
Yeah. A lot of times you see acquiring companies come in and make sweeping changes, imposing their own systems and processes.
Right.
Buffett believes in preserving the entrepreneurial spirit and the unique cultures of the businesses he acquires.
He does. It's about finding businesses that are already well run and then giving them the resources and support they need to continue to thrive.
Right. It's like gardening.
Yeah.
You know, you plant the seed, you nurture it, you let it grow.
You let it grow. Exactly. So how does Buffett manage to maintain such a strong and consistent culture across such a vast and diverse organization?
Right.
I mean, we're talking about hundreds of different businesses operating in all sorts of industry.
It's not easy.
It's not easy, right?
But Buffett does it by leading by example. He embodies the values and behaviors he expects from his managers. He's known for his integrity, humility, work ethic, and unwavering focus on long-term value creation.
He walks the walk.
He does.
And that sets the tone for the entire organization.
Absolutely. And he also reinforces the culture through his communication with managers and shareholders. His annual letters are legendary for their wit, wisdom, and insights into his investment philosophy and business principles.
They're more than just dry financial reports.
Right. They're a must-read for any investor.
They are.
Yeah.
And he does it in a way that's engaging and accessible.
Yeah, he's a great storyteller.
He is a great storyteller.
He can explain complex concepts in a way that anybody can understand.
Yeah, he avoids the jargon and the complex financial concepts.
Right. It keeps it simple.
He keeps it simple.
Yeah.
He also reinforces the culture through Berkshire's annual meeting.
Oh, yeah.
Which has become a pilgrimage for value investors from around the world.
It's like Woodstock for capitalists.
It is. It is. And the meeting is a celebration of Berkshire's unique culture. It provides an opportunity for shareholders to hear directly from Buffett and Munger, to ask them questions about the company and its future.
Yeah, it's a chance to get some FaceTime with the Oracle of Omaha.
Exactly. And it's a testament to Buffett's commitment to transparency and his belief in treating shareholders like partners.
He really values that relationship.
He does. And it's remarkable how he's managed to create this sense of community among Berkshire shareholders.
It's like a big family.
It is. It is. It feels more like a family gathering than a corporate event.
And that's a testament to the power of a shared vision.
Yeah.
And a strong culture.
It is. It is. Okay. So we've covered a lot of ground in this second part of our deep dive.
Yeah.
We've explored the diversity of Berkshire's businesses, the challenges they've faced, and the key principles that have guided their success.
The secrets to their success.
Secrets to their success, right. And we've also delved into the unique culture that Buffett has fostered at Berkshire.
Right.
A culture built on trust, autonomy, and a long-term focus on value creation.
It's a powerful formula.
It is a powerful formula, and it's a fascinating and inspiring story.
It is.
In the final part of our deep dive, we'll examine some of the specific investment decisions that Buffett made in 2010,
right.
his views on the market environment, and his timeless advice for investors.
Sounds good. Looking forward to it.
All right. Welcome back to our deep dive into Warren Buffett's 2010 letter to Berkshire Hathaway shareholders.
Okay.
We've spent the last two parts kind of unpacking, his business philosophy, his unique management style, Berkshire's diverse holdings.
Yeah, a lot to cover.
Lot to cover. Right.
Lots of ground.
Lots of ground, but I think we're getting a good sense of how this guy thinks.
I think so. It's really fascinating to see how all these different pieces fit together.
It is. Now let's shift our focus to the heart of it all, right? Buffett's investment approach.
Right. Yeah. Let's get into the nitty-gritty.
Yeah, because at the end of the day, Berkshire Hathaway is an investment company.
Precisely.
Right.
And this letter really, really gives us a window into how Buffett and his longtime partner, Charlie Munger, how they think about building a portfolio for the long term.
Right, for long-term success.
Long-term success, yeah.
So let's talk about Berkshire's stock holdings.
Okay.
The letter provides a table listing their largest investments at the end of 2010. We see some familiar names there: Coca-Cola, Wells Fargo, American Express, Procter & Gamble.
Yeah, blue chips, solid companies.
Blue chips, solid companies, right. And what stands out to me is the diversity of those holdings.
It is a pretty diverse mix.
It is. I mean, they span consumer staples, financial institutions, industrials, even a railroad.
Right. It's not just about picking winners in one sector.
It's not. It's about, and this is classic Buffett, right? It's not just about diversifying for the sake of spreading risk.
Right.
It's about carefully selecting companies that he believes have a durable competitive advantage. What he calls a moat.
Right, that moat, yeah.
That moat that can generate consistent earnings over time.
Exactly. He's looking for businesses that are built to last, businesses that can weather economic storms and emerge even stronger.
They are. And he's not afraid to hold on to those companies for the long haul.
Right. He's not a trader.
He's not a trader. He's an owner.
He's an owner.
He believes that time is the friend of a wonderful business.
Absolutely. And that's such a key takeaway for any investor.
It is.
Patience. Patience is essential.
Patience is essential.
It's not about chasing quick profits or trying to time the market.
Right.
It's about finding great businesses and letting them compound value over time.
Absolutely. Speaking of compounding, Buffett also discusses his investment income in 2010.
Okay.
He points out that it was affected by a few factors, including low interest rates and the redemption of some high-yielding investments.
Right. So it wasn't a banner year for investment income.
It wasn't. But this is a challenge that many investors face.
It is, especially in a low interest rate environment.
Right, especially in a low interest rate environment.
It's tough to find those investments that generate a decent return without taking on too much risk.
Right. And Buffett also expresses his frustration with regulations that limited dividend payouts of some of Berkshire's holdings.
Oh, interesting. So he's not just talking about market forces, he's also talking about government policies.
He specifically mentions Wells Fargo.
Okay.
Which he believes was forced to maintain an artificially low dividend payout despite its strong financial performance.
So he felt like the government was kind of tying their hands.
Yeah, he did. But he's confident that those regulations will eventually be lifted.
Okay.
And that Wells Fargo will be able to resume a more rational dividend policy.
Which would benefit Berkshire shareholders.
Which would, of course, benefit Berkshire shareholders.
Right. Yeah.
So it's not just about finding great companies.
Right.
It's also about navigating the regulatory landscape, and anticipating how policy changes might impact your investments.
Oh, absolutely. You got to be aware of the bigger picture, the economic, political, and regulatory forces that can really shape the market.
Yeah, it's a complex world out there.
It is.
All right, now let's talk about a topic that always gets people excited, right?
Okay.
Succession planning.
Yes. The elephant in the room.
The elephant in the room. We all know Buffett isn't getting any younger.
Right.
And shareholders are naturally curious about who will eventually take the reins at Berkshire.
It's a big question, yeah.
It is. It is. Well, in this letter, Buffett shares some insights into the process.
Okay.
He reveals that they've identified several outstanding candidates who could step into his role as CEO.
So they've got a plan in place.
They've got a plan in place, but he admits that finding successors for their investment roles has been more challenging.
Right, I can see that. I mean, it's hard to replicate that kind of track record, that kind of investing brain.
Right. I mean, you're talking about, decades of experience, a deep understanding of markets, a unique ability to identify value.
Exactly. It's not just about finding someone who's smart. It's about finding someone who shares that same philosophy, that same temperament, that same long-term vision.
Absolutely, absolutely. But in 2010, they did announce that they had found the first of these successors.
Oh, okay.
Todd Combs.
Todd Combs, yeah.
A talented hedge fund manager who really impressed Buffett with his investment acumen and his deep understanding of risk.
So that was a big development.
It was a big development. It signaled that Buffett was serious about preparing for the future and ensuring that Berkshire would continue to thrive after he and Charlie were no longer at the helm.
Right. It's a sign of confidence in Combs and a commitment to ensuring a smooth transition.
Absolutely. Absolutely. Okay, let's shift gears again and talk about a topic that Buffett has been very vocal about.
Okay.
His aversion to leverage.
Leverage. Using borrowed money to amplify returns.
Right. Using borrowed money to amplify returns.
Yeah, it's a double-edged sword.
It is. It is. And he reiterates this view in the letter, arguing that leverage can be incredibly dangerous.
Yeah, it can magnify your gains.
Right.
But it can also magnify your losses.
Exactly. He has this great line. He compares credit to oxygen.
Oxygen.
Yeah, he says you don't notice it when it's plentiful.
Right.
But its absence can be fatal.
Wow. Yeah, that's a powerful analogy.
It is a powerful analogy. It really is. And it underscores the importance of maintaining a strong financial position.
Right. Having that margin of safety.
That margin of safety. Exactly. And he goes on to share a personal anecdote about his grandfather.
Oh, interesting.
Who ran a grocery store during the Great Depression.
Okay.
And his grandfather really instilled in him the importance of liquidity and financial conservatism.
Lessons that have stayed with him throughout his career.
Absolutely. And he emphasizes that Berkshire's top priority is protecting its reputation and ensuring its long-term survival.
Which makes sense.
Right.
If you want to be around for the long haul.
You got to play it safe. You got to be conservative. And that means avoiding excessive leverage and maintaining a fortress balance sheet.
Right, having that financial strength to weather any storm.
Exactly. They always keep a substantial amount of cash on hand, even during good times, so that they're prepared for unexpected events.
Right.
And can take advantage of opportunities when others are forced to retrench.
So they're always ready to pounce when those opportunities arise.
Always ready to pounce. Exactly. And he cites the example of their massive investment spree in the aftermath of the Lehman bankruptcy in 2008.
Oh, right. When everyone else was panicking.
Yeah, when everyone else was panicking.
They were buying.
They were able to act decisively because they had the financial strength to do so.
Right. They had the dry powder.
I had the dry powder. Exactly. So even though their cautious approach, might penalize returns to some extent, Buffett believes that the peace of mind and the ability to play offense during times of crisis more than compensate for those, slightly lower returns.
Right. It's about playing the long game,
yeah,
not chasing short-term games.
It is. Absolutely. All right. Speaking of the long game, Buffett also offers some insights on the broader market environment. He acknowledges that the market can be irrational in the short term, driven by fear and greed.
Right. Mr. Market, as he calls it.
Mr. Market. Exactly. But he's confident that over the long term, the market will reflect the underlying value of businesses.
So he's still a believer in the efficiency of markets.
He is. He is. Ultimately, he is. And that's why he urges investors to focus on finding companies with strong fundamentals.
Right.
And durable competitive advantages.
Moats again.
Those moats again, right. And to avoid getting caught up in market hype or short-term fluctuations.
Tune out the noise.
Tune out the noise, exactly.
Focus on the signal.
Focus on the signal, the true value of a business.
Exactly.
He also stresses the importance of patience and discipline.
Yeah, those are recurring themes.
They are recurring themes, but they're so important.
They are.
Right. Don't chase returns. Don't try to time the market. Just invest consistently over time in high-quality businesses and let the magic of compounding work its magic.
It's simple advice, but it's incredibly powerful.
It is. It is. And it's a reminder that investing doesn't have to be complicated.
Right. It's not rocket science.
It's not rocket science.
It's about finding great companies and letting them grow over time.
Exactly. Exactly. So as we wrap up this deep dive into Warren Buffett's 2010 shareholder letter, what are some of the key takeaways for you?
Well, I think for me, it's about the importance of long-term thinking, the power of compounding, the value of investing in businesses you understand and believe in.
Yeah, I completely agree. And I think it's also about the importance of integrity, humility, and a willingness to learn from your mistakes.
Right. Those are qualities that Buffett embodies, and they're qualities that any investor can aspire to.
They are. They are. And this letter it's more than just a financial document. It's a window into the mind of one of the greatest investors of all time.
Absolutely.
And it's packed with timeless wisdom that can benefit investors at any level of experience.
It's a must-read for anyone who's interested in investing.
It is. It is. So if you haven't already, I highly recommend reading the full letter. It's a treasure trove of insights and inspiration.
It really is.
And remember, even if you're not managing a portfolio the size of Berkshire Hathaway's, you can still apply Buffett's principles to your own financial decisions.
Absolutely. Think like an owner, focus on the long term, and don't be afraid to be patient.
Right.
Those are the keys to building lasting wealth.
Absolutely. Well, thanks for joining us on this deep dive into Warren Buffett's world. Until next time, keep learning, keep exploring, and keep diving deep.
Thanks for having me.